Hello everyone, this is Brandon Garrett from Snow Garrett Wealth Management with an economic update for August 2016. In this month's video, we will talk about some of the events that influence markets in July and give you some insight into what they could mean for you as an investor. Please stay tuned at the end for a required disclosure statement. Markets had a lot to think about in July. A British exit, interest rates, and earnings season all affected market movements last month. After dropping sharply at the end of June following Britain's vote to leave the European Union, markets regained steam and rallied for 4 straight weeks, pushing the S&P and the Dow to new records. We often talk about the importance of not overreacting to market declines, and this is the reason why. We can't predict how markets will perform after a shock, but the biggest market days often come shortly after a pullback. Calmly assessing the situation and avoiding emotional responses is a smart strategy for long-term investors. Let's talk about some of last month's economic events. The Federal Reserve held another open market committee meeting at the end of July and voted to keep rates steady. The Fed's decision wasn't surprising, and now the debate is on over whether or not central bankers will raise rates at all this year. Investors were surprised at the end of the month by a low first estimate of second quarter economic growth. The first official measure of second quarter gross domestic product showed that the economy grew just 1.2% over the previous 12 months after growing 1.1% in the first quarter. This came as a big shock as economists had expected to see over 2% growth last quarter. Over the past few years, the economy has set a pattern of slowing down in the first quarter and roaring back in the second. Though we'll see several more official revisions of the GDP growth estimate, 2 quarters of slow growth is somewhat concerning. However, looking at the data, we see that a drop in business inventories ate away at growth. Economists expect that to actually boost economic growth in the rest of the year as businesses rebuild their stockpiles. Consumer spending was the biggest driver of economic growth last quarter, which is a great sign for the economy. A strong labor market, rising home prices, and wage gains all support additional consumer spending this year. The Federal Reserve took the GDP report in stride, stating that they believe near-term risks have diminished. We can take this to mean that they want markets to prepare for a possible rate hike this year or early next. What can investors expect in the coming weeks? In a word, volatility. Overall, economic fundamentals in the U.S. are looking solid. However, turmoil overseas, a presidential election, and anticipation of a future interest rate increase will likely affect market movements. As always, we'll keep you informed. That's it for this month's economic update. Please remember that nothing we talk about here is a recommendation. If you would like to discuss your personal financial situation, please give us a call at 817-550-6750. We'd be happy to talk to you.